In this video, traders, we're going to look at what happened to Neil Woodford and his fund. Stay tuned. Hey guys, a warm welcome to you. Alright, so you may have seen in the news recently, as the time I film this video, or depending on watching this, Neil Woodford, who was really kind of one of the UK's well-known fund managers. He had a really good run over at Invesco Perpetual. He had a really kind of good track record around him. He was a good stock picker. He made a lot of money in the dot-com crash because he was buying kind of the utility stocks and not these frothy companies. So he's just had a good track record. He went out and he set up his own fund. And he's got a couple of funds, but one of them I'm going to talk about today is the Woodford Investment Management. So Woodford Investment Management has 3.7 billion at this moment in time, or 3.7 approximately. At its peak, it had 10 billion pounds worth of assets under management. It's worth mentioning, guys, before I carry on the video, that I've done some research here. I don't claim to know that this is correct, so take everything with a pinch of salt. I always take everything with a pinch of salt that I read on the internet, but I've compiled loads of different bits and pieces, and I'm going to add my own opinion to it as well. And again, my opinion. So, to take it for what it's worth. So anyway, this guy, Neil Woodford, doing really, really well, super well. His fund was doing okay for a while. And then he basically had a lot of drawdown over the past few years when the FTSE All Share or whatever benchmark you want to use it was kind of chugging along. It has been stagnating a bit recently, but his fund was losing money. Over the last 2 years, it was down 34% over a 2-year period. And unfortunately, what happens with that is you get 23 months of consistent outflows, bigger than inflows. In other words, people pulling money out was greater than people putting money in. So that was starting to put him under a bit of pressure, right? As a fund manager, that's not what you want to see. You want to see inflows, you want to see good performance, steady performance, at least not drastic underperformance. And you want to see money flowing into the fund as people have confidence and invest in you, as opposed to money being dragged out, which is a sign that investors aren't really that keen and they want to pull their money out. So this is what was happening. Backstory: not doing so well. We'll look at some of his worse or poorer investments or trades, if you like, at some point in a moment. But the kind of straw that broke the camel's back is that Kent County Council had some pension funds in Woodford's fund, and they asked to withdraw 263 million they're holding. Now, this was the trigger for this whole scenario. So Neil Woodford then said, right, no, I'm sorry, I'm not going to allow people to withdraw funds. And the reason he said that I've got a portion of assets that are in illiquid, unquoted instruments. And if everyone's going to pull their money out, specifically if Kent County Council are going to ask to pull out 263 million, that's going to negatively impact. I haven't got a buyer effectively for those illiquid or unquoted assets. Now, this is where it gets interesting, guys, because this has been my opinion as well. Now, we'll get to a moment whether he should have been doing that or not in a moment, but let's just think of the logistics of it. If you have a spread of money and you've got some in normal quoted shares that trade on the stock exchange, London Stock Exchange, and you've got some in other companies that are illiquid, then you cannot physically just pull the money out. You cannot do it, i.e. there's no buy. You have to go out and find a buyer. Now, if you're fire selling shares, you're going to get an awful price as well. So one, there is no buyer there. It's not quoted. You can't just get the prices available. It's not like going in and punching in Apple onto your screen and selling, or selling over a period of weeks or whatever it may be to reduce the impact, as you would normally do. If you were liquidating assets and they were traded, you would spread the impact as much as you could, unwind the position, return the money to investors. If there is no bid for it, so to speak, then you've got to go out there and find a bid. So there's that. And then, of course, if people know that you are struggling and you have to sell because you have withdrawals, you think you're going to get a good price? No, you're not. And so Neil Woodford has said, listen, give me chance to unwind this. I can't just sell it all instantly because I have a lot of illiquid, unquoted stuff and I need to find a buyer for it. And I think, this is my opinion as well, and again, with some of the facts, I'm sure there's plenty of facts that we're not getting, that seems like a sensible move to protect people getting hammered on just pulling the plug out of panic. Now, I appreciate there's loads of stories as well of people who've got private money in there, family money in there, and they want it back, and that makes perfect sense. They're entitled to it back. But I think that the reason he's done it, and of course, I could be wrong here, but the reason he's done it is so that he can maximize the amount of money he's returning. It doesn't look like he's doing it to be deceitful. It doesn't look like he's doing it to try and stop people getting their money. He's just saying, hey, listen, I can't sell it all at once. And if I tried to, I'd get an awful price, which would affect you guys. So I'm closing it down now in terms of withdrawals. Let me try and to shift stuff away from those illiquid, unquoted stuff into more liquid assets. And then when I open it again, you can pull out as much as you want, because I'm just about to sell it at the click of a button almost. And that'll happen then for the next however many years. So to me, it makes kind of operational sense from a logical perspective. From an emotional perspective, I can see why people are super angry. They're like, hey, it wasn't gated, it wasn't locked up before, now it is, I want my money back. And you can understand both sides of the argument. But for me, the logical side of it is probably correct in that, hey, you're going to get probably more money back, your withdrawals, if you just let me unwind this slowly, and it may take some more time, but it'll probably do you better in the long run. That's just my opinion on it. Let me know your thoughts in the comment section below, guys, if you think that's right or wrong, or if you know anyone who's invested in Woodford's fund. Okay, so that was the kind of straw that broke the camel's back. And the fund decreased by 560 million in 4 weeks, of which 190 million withdrawals and 370 million were losses. So we're talking, this is pretty significant drawdown here, which is of course why people are pulling money out. Kent County Council have sat there in the boardroom and they've gone, listen, we can't afford to be drawing down this. We need to put it into something more stable. This is significant drawdowns here. We're in trouble. And of course, the same with people, retail investors like you and I. We've got some money in the fund. Potentially, we see what's going on. We're losing 10% here. I'm down another 10%. Okay, at some point, you're going to pull the trigger and go, right, well, I need that money out and then I do something else with it. This is not working. And especially over a 2-year period, it's not just a blip, a quarter, where he writes the investment letter and says, hey, this quarter's not been so good. We'll work it out. It's because of this, this, and this. And you kind of ride through the storm. 2 years, people have given it a bit of time and are, kind of losing a bit of confidence. So there's two different arguments here. One is his ability to create return, and the other is obviously the fact that he's now put a break on withdrawals. So regard his holdings and what he's been doing. Again, picking bits and pieces off the internet, doing a bit of research, sharing with you guys. Is it accurate? I would assume it may be, but who knows? Some of the facts aren't always there, are they? 101 companies held. He's got house builders, logistic companies in there. Now, this is where it gets interesting. EU rules state that 10% or less of the assets have to be in unquoted shares. So this is to prevent this, basically. So you can't have a fund that's full of illiquid, unquoted stuff, because it doesn't allow people to withdraw the money. So EU rules say, hey, listen, you can have some, up to 10%. Any more than that have to be in listed, quoted, well, I didn't say listed, have to be in quoted shares, i.e. something where there's a bid and offer. Now, the spread could still be huge on them, but there still has to be some liquidity to get out of, something there, unquoted. And there's also, from the fact of a mark-to-market valuation, you can't value the fund if it's not quoted. If it's not quoted, what value are you going to put on it? And it becomes very, very tricky then. I know that there's lots of ways that people do this, but it's difficult to value your book if it's not quoted. So there's reasons why they do that, and you can understand that to a certain extent to protect people investing in it. Now, this is where, again, this is what I found out. Apparently, Neil Woodford had circumvented the rules by doing a couple of things. One of them was he put those unquoted shares into his Patient Capital Investment Trust, which was quoted, and then put those shares from the Patient Capital Investment Trust into his Woodford Investment Management Fund. Okay, so they were technically then still quoted because the actual share was quoted from his trust, but the holdings within that were unquoted. So that's not against the rules. There's people saying it's not in the spirit of things and this and that and the other, and you could argue, yes, he's kind of finding a loophole with that, because technically, if he was to sell those, he's still got to, it doesn't matter how many kind of nesting of clusters of companies or whatever, you still got to ultimately sell that final asset, unless that company, of course, has got enough funds to cover that and deal with itself. But obviously that's probably going to be a long shot. Another thing he did was he listed some of these on the Guernsey Stock Exchange where there were no bids, there were no prices there. Even though they're listed, there was nothing going on there. So even though technically it was quoted, no liquidity available. So Some people are saying, you know, he circumvented rules, he wasn't quite doing it by the book. Other people are saying, well, he was following the rules. It's one of those things, isn't it, guys? It is what it is. It looks like, I mean, who knows what's going to happen in the future when stuff comes out. It looks like he had the best intentions. He's trying to create the best return for investors. He's trying to do what he can within the rules, etc. Has he broken them a bit here? Maybe technically not. Is it put in dangerous position? Well, now it looks like it has. So we'll see what happens going forward, and obviously depending on when you're watching this, we'll see how the outcome has been. A lot of noise saying he should have been looked at beforehand with this outflow of cash and the unperformance. You know, should there be some sort of watchdog looking over this kind of thing? Should there be alarm bells ringing? As there always is, guys, there's always going to be some kind of report, some kind of analysis, or some kind of dissection of what's going on. But anyway, these are the facts. I say in facts inverted commas so far. I say internet facts so far. If you know anything else, stick in the comment section below. That's my opinion on it, and that's what we know so far. So that was what's happened to Neil Woodford. We'll see. Take care. Bye bye.